Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Merck dates its American history to 1891, when George Merck established a U.S. subsidiary of the German pharmaceutical firm. Today, it's a fully independent global company, headquartered in Rahway, New Jersey.
A defining moment in Merck's history came in 1944, when scientists working with the company helped develop streptomycin, the first effective antibiotic treatment for tuberculosis, establishing its research credibility.
Merck's business today is overwhelmingly concentrated in pharmaceuticals, which make up over 90% of total revenues. The remaining portion comes from its animal health segment, a global veterinary medicines business.
Within pharmaceuticals, the centerpiece is Keytruda, the brand name for pembrolizumab. Keytruda is an anti-PD-1 immunotherapy that works by releasing the immune system's natural ability to attack cancer cells.
Keytruda's first FDA approval came in 2014 for melanoma. It has since expanded to over 40 cancer indications and is now the world's best-selling medicine by annual revenue.
Keytruda represents roughly 45% of Merck's total revenues, creating enormous leverage when it grows and real risk as patents approach expiration later this decade.
Merck's patent protections on Keytruda extend into the late 2020s, giving the company years of runway to reinvest those cash flows into the pipeline that will carry it through the post-Keytruda era.
R&D consumes roughly 24 cents of every revenue dollar, among the highest intensity in pharma. That investment is what keeps the pipeline full of potential Keytruda successors.
Beyond oncology, Merck's Gardasil vaccine protects against the human papillomavirus strains that cause cervical cancer. Gardasil has become one of the world's most widely distributed preventive vaccines over 2 decades.
The animal health segment provides a stable counterweight to pharmaceutical volatility. Merck's veterinary medicines reach companion animals and livestock in over 50 countries, generating predictable fee-based revenues.
On the competitive front, Merck faces rivals like Bristol-Myers Squibb in oncology immunotherapy, though Keytruda's breadth of approvals and established prescriber relationships are difficult for any challenger to displace quickly.
Operating margins run around 26%, and net margins sit near 22%, healthy for a research-intensive pharmaceutical company, reinvesting heavily in both internal programs and external acquisitions.
Robert Davis became CEO in 2021 after serving as CFO for 7 years. His finance background drives a sharp focus on capital allocation across R&D and M&A.
Under Davis, Merck has made targeted acquisitions to build out its oncology and cardiovascular pipeline, supplementing internal research with external bets on promising clinical-stage compounds and platforms.
Merck operates manufacturing and commercial facilities across 5 continents, with its medicines available in over 140 countries through both direct commercial teams and distribution partnerships.
The dividend has grown for 14 consecutive years and at a yield near 3% offers income investors meaningful return alongside the long-term pipeline optionality embedded in the research portfolio.
That's the company chapter for Merck. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Merck reported Q1 2026 revenue of $16.29 billion, up 5% year over year. Adjusted EPS of $2.59 beat the $2.40 estimate by 7.9%. GAAP earnings were negative due to large tariff-related intellectual property reserve charges. The stock fell 2.6% in pre-market, a modest negative reaction despite the beat. Keytruda remains the dominant asset, but the 2028 patent cliff looms large.
Merck & Company Incorporated is a global pharmaceutical giant headquartered in Rahway, New Jersey, founded in 1891. The company operates across 2 segments, pharmaceutical and animal health. The pharmaceutical segment generates roughly 94% of revenue, anchored by Keytruda, pembrolizumab, approved for over 40 tumor types and the best-selling oncology drug in history. Merck Animal Health at $5.5 billion annually, is the world's second-largest animal health business.
At $269 billion in market cap, Merck trades at 14.9 times trailing earnings, a discount reflecting the 2028 Keytruda patent cliff. Beta of 0.28 makes Merck one of the most defensive megacaps in the index. The 3% dividend yield is among the highest in large-cap pharma. Forward PE of 21.4 times, above trailing, signals analysts expect earnings to decline.
Revenue of $16.29 billion grew 5% year-over-year, a deceleration from the 12% growth posted in Q1 2025. Adjusted EPS of $2.59 beat the $2.40 estimate by 7.9%. The beat was driven by lower operating expenses and Keytruda pricing strength rather than volume acceleration. GAAP EPS was negative due to large charges related to tariff-driven intellectual property reserve adjustments.
Gross margin reached 81.5%, consistent with Merck's pharmaceutical-only business model at premium drug pricing. Operating margin of 41.2% on an adjusted basis reflects efficient operations despite elevated R&D investment. Net margin of 28.1% on an adjusted basis is strong but expected to compress as Keytruda faces pricing pressure under IRA negotiation.
Keytruda revenue for Q1 2026 is tracking above $7 billion for the quarter, an annualized run rate exceeding $28 billion. The drug has approval in lung, bladder, cervical, head and neck, colorectal, endometrial, melanoma, and over 30 additional tumor types. Each new indication adds incremental patients and revenue without a new drug launch. Keytruda is the most diversified single-drug revenue stream in pharmaceutical history.
Winrevair, sotatercept for pulmonary arterial hypertension, launched in 2024 and is tracking toward $5 billion in peak annual sales potential. Q1 prescription volumes exceeded initial analyst estimates. Winrevair represents Merck's most important post-Keytruda revenue driver currently on the market and is critical to the company's ability to offset the 2028 patent expiry impact.
Merck Animal Health grew 8% in Q1 2026, generating approximately $1.4 billion in quarterly revenue. The segment benefits from structural tailwinds in livestock productivity, companion animal healthcare spending, and aquatic health markets globally. Animal health is a consistent mid-single-digit grower that provides earnings stability independent of the human pharmaceutical cycle.
Free cash flow on a trailing 12-month basis reached $12.36 billion. Cash on the balance sheet is $14.57 billion. Net debt of $35.97 billion is elevated but manageable given free cash flow generation. Full year 2026 EPS estimate of $5.10 is below the trailing EPS of approximately $7.32, confirming analysts expect earnings to decline toward 2028.
The inversion of forward PE above trailing PE is the key valuation signal for Merck. Most growth companies show the opposite, lower forward PE as earnings grow into a higher stock price. Merck's inverted PE structure tells you exactly what the market is pricing. A peak earnings period in 2025, followed by a declining trajectory toward 2028, as Keytruda negotiation and biosimilar pressure hit simultaneously.
Analyst consensus is 24 buys, 11 holds, and 1 sell, a constructive positioning relative to the stock's recent underperformance. The average price target of $135 represents 24% upside from the current $109 price. Analysts are more optimistic than the market, arguing the Keytruda cliff is over-discounted in the current valuation.
The bull camp within the analyst community focuses on pipeline depth. Merck has over 20 Phase 2 and Phase 3 programs in oncology, including subcutaneous Keytruda formulations that could extend commercial exclusivity and patient convenience beyond the IV formulation patent. Capvaxive, the pneumococcal vaccine candidate, is positioned to challenge Pfizer's Prevnar franchise in the adult vaccination market, representing a potential multi-billion-dollar revenue opportunity.
Bernstein and Barclays both carry outperform ratings, citing Winrevair's strong launch trajectory as evidence that Merck's pipeline can partially replace Keytruda's revenue. The math is difficult, Keytruda at $28 billion annually requires replacing more than the combined revenue of most standalone pharmaceutical companies. No single pipeline asset closes that gap, but a portfolio of Winrevair, Capvaxive, animal health growth, and subcutaneous Keytruda can collectively cushion the cliff.
The more cautious analysts at Goldman and Citi note that forward PE of 21 times already embeds significant recovery assumptions for post-cliff earnings. If Keytruda negotiated prices come in at the lower end of the IRA range and biosimilar entry happens ahead of schedule in 2028, EPS could trough closer to $4 per share, implying the current stock price is fair value, not undervalued.
The bull case for Merck is a misunderstood patent cliff. The market prices Keytruda's 2028 U.S. expiry as a cliff, a sudden, severe revenue drop. In practice, Keytruda is entrenched across 40-plus indications in hospital formularies and treatment guidelines. Biosimilar uptake in oncology historically occurs more slowly than in other therapeutic areas. Physicians are reluctant to substitute active cancer treatments. Revenue erosion may be gradual rather than abrupt.
Winrevair is a category-defining drug in pulmonary arterial hypertension. It is the first activin signaling inhibitor approved in the disease, a new mechanism that complements existing prostacyclin and endothelin pathway drugs. With peak sales potential above $5 billion and strong launch metrics, Winrevair, combined with animal health growth and the oncology pipeline, provides a credible earnings stabilization story for the 2029 to 2032 timeframe.
The bear case starts with the math. Keytruda generated over $28 billion in annualized revenue in Q1 2026, approximately 45% of Merck's total revenue. Losing pricing power on 45% of revenue in 2028, when combined with additional IRA negotiation on other products, creates an earnings headwind that no reasonable pipeline can fully offset within a 3-year window.
IRA drug price negotiation on Keytruda is eligible in 2026 for implementation in 2028. Historical IRA negotiated prices have averaged 25 to 60% below list price. If Keytruda receives a 50% price reduction on its Medicare volumes, roughly 30% of total Keytruda revenue, annual EPS impact exceeds $3. That is a 40% reduction in current adjusted EPS.
Gardasil, Merck's HPV vaccine, faces significant headwinds in China. The Chinese National Immunization Program has reduced reimbursement rates for Gardasil, and geopolitical tensions create uncertainty around long-term market access. Gardasil has historically been one of Merck's highest margin products, contributing over $2 billion annually. Any meaningful volume loss in China directly impacts earnings.
Net debt of $36 billion limits financial flexibility at a critical juncture. Merck must invest heavily in pipeline to offset Keytruda while managing debt service simultaneously. Share buybacks are constrained. The balance sheet is not a crisis, but it prevents Merck from acquiring a large revenue replacement asset without significant dilution.
The large-cap oncology peer comparison, Merck versus Bristol-Myers Squibb. BMS faces a comparable patent cliff with Revlimid erosion and Eliquis pressure. BMS trades at 10.8 times forward, a discount to Merck's 21 times, because BMS's replacement pipeline is less mature. Merck's Winrevair and Capvaxive are ahead of BMS's post-cliff candidates.
Versus AbbVie, which navigated the Humira biosimilar transition, Merck's Keytruda cliff is viewed as more severe. AbbVie's replacement drugs Skyrizi and Rinvoq were growing above 50% when Humira erosion accelerated. Merck's equivalents are not growing at comparable rates. AbbVie trades at 18 times. Merck at 21 times is a premium requiring pipeline execution to match AbbVie's transition success.
Johnson & Johnson at 15 times forward earnings is the diversified pharma comparison. J&J benefits from a medical technology segment providing revenue stability that Merck lacks. Merck's pharmaceutical concentration makes it more levered to the Keytruda narrative. Upward if the cliff proves manageable, downward if negotiation or biosimilar entry exceeds expectations.
Pfizer at 11 times is the cautionary tale. Pfizer struggled to replace COVID vaccine and Paxlovid revenue, leading to persistent multiple compression. If Merck fails on its post-Keytruda pipeline, similar to Pfizer's post-COVID struggles, the 21 times forward PE is not a floor, but a starting point for further derating.
Pre-earnings options positioning was neutral to bearish. Elevated put buying at the $100 to $105 strikes reflected investor hedging against a Keytruda guidance cut or IRA pricing announcement. The put-call ratio was above 1.2, the highest level among major pharma companies ahead of Q1 earnings. The actual 2.6% decline is modest relative to the bearish positioning. The earnings beat limited downside.
Post-earnings options activity shifted toward covered call writing, institutions selling upside to collect premium while maintaining long exposure. The strategy is consistent with a range-bound stock view. Investors believe Merck is fairly valued at $100 to $115 near term, but want income while waiting for clarity on the Keytruda IRA negotiation outcome. Elevated implied volatility post-earnings makes call selling more rewarding than usual.
Insider activity at Merck is routine. CEO Rob Davis and board members participate in standard equity vesting without material open market purchasing or selling. The dividend has grown for 14 consecutive years. Management has not signaled any intention to cut despite the earnings decline trajectory toward 2028.
Institutional ownership skews defensive. Vanguard, BlackRock, and State Street hold over 20% combined, seeking the 3% yield and low beta. This creates natural price support. If the stock fell to $90, the yield would exceed 3.7%, attracting significant income fund buying.
Merck delivered $16.3 billion in revenue, up 5%, adjusted EPS of $2.59 beating by 8%. Keytruda continues compounding across 40-plus indications. Winrevair's strong launch is the most important new revenue signal. The 3% dividend provides income support with low beta.
Risks are real. Keytruda cliff in 2028, declining EPS trajectory, IRA negotiation, Gardasil China exposure. At 109 against a 135 target, the risk-reward favors patient income investors. Watch IRA negotiation timing as the key catalyst. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.